Our next guest is bearish on the precious metals for the moment, but says a breakout in gold can happen any day. He's Gregory Weldon of Weldon Financial, and he's coming up on the spot. Gregory, so nice to see you again. It's been a while.
Good to see you.
So last time I saw you, Greg, was in Palm Springs. We may have been better off then, right?
Yeah, well, the Jersey Shore is pretty nice in the summer, too. It doesn't compete with Palm Springs, but it's a close second.
So your last piece that you wrote, Greg, is really focused on the issues in Europe and what a week we saw in Europe last week with the EU summit. Were you surprised to see interest rates cut to a record low? And are you surprised by what's happening there overall?
Well, no, I wasn't surprised, nor was the market surprised. And I think this is part of the problem. I mean, the market fully anticipated the rate cut from the ECB. And in fact, they are anticipating another rate cut from the ECB, and they have been for some time. So they're looking for 50 basis points of cuts. They got half of that, the rest expected by the end of the year. So it would take something beyond that to surprise the market. And if you go back, I mean, the bang for the buck that European officialdom was able to generate from this bailout of banks, which really wasn't even a bailout. What it was a backstop of deposits, essentially creating an FDIC of Europe and insuring deposits so that the fear of a run on European banks has been squelched. Well, that's great. Sure, it's good news for the bank shares to some degree, but what it doesn't do is address the sovereign debt issue, and what it doesn't do is address the macro deflation that's taking place in Europe. They did a nice misdirection in deflecting attention from these two things, which remain front and center in my view. And this is why I think bonds are under pressure so quickly again, and Spain has become a focal point already, this quickly.
So besides Spain, Greg, you say most at risk are Italy and France.
That's right. Data, it's interesting because data since this bank backstop was announced shows that Italian deficit, this year's fiscal deficit to GDP ratio at 8% in the first quarter. That's the third highest reading ever. It tends to peak in the first quarter seasonally, so it should come down over the rest of the year, but still going to put it well out of where it's supposed to be. They're supposed to be cutting back. When you break down, spending versus revenue, it's not a tenable situation. It's getting worse in the near term when you also have a medium-term and long-term crisis going on. That's not positive. And when you look at France, another case in point, despite the fact that revenue was up, their spending was through the roof. It's a new socialist government. This dynamic's not likely to change. Their deficits blowing out larger year over year, and that's problematic going forward when you have a huge amount of debt in both these countries. Then when you put the focus on Germany from a macroeconomic perspective, eroding very quickly. And I think that this is troubling, very troubling.
So let me ask you, Greg, last year when we saw the EU crisis emerge and all those issues in Greece, it was really helping gold. This year, the crisis in Europe is not really helping the yellow metal. How come?
Well, if you look, if you see when the periods when gold has been most bullish, it really links up to either Fed pumping of money or ECB pumping of money. And right now, you really have neither. ECB balance sheet has made a nominal new high, but it's not accelerating at all. Same with the Fed. You look at some of the long-term rates of change, it's actually, down to flat. So you don't have the same kind of money printing, pumping of the presses here that you've had, in 2009, 2010, even into 2011. The Fed has promised to do more. Operation Twist being extended really isn't that big a deal. They do want to flatten the curve. That's the only place they have any juice left is in the long end. So they have to flatten the curve. This is their approach. It will become more forceful, I think, once the U.S. election situation is cleared out and we get more clear policies in terms of taxes for next year and healthcare and things like this. But I think the Fed is boxed in. That makes it difficult. ECB, similar situation. The officialdom, the political situation is taking center stage. They're not pumping money. The LTRO is, ceased to be, effectively adding money to the system. China's the only one cutting rates, and frankly, they're behind the curve because inflation is falling faster. Real rates are rising in China. So this doesn't create a scenario where asset prices, including gold and silver, tend to benefit.
So, Greg, most analysts I've spoken with have said they don't expect the Fed to do anything from now until the election, don't expect anything from now until after November. Do you agree with that?
I would agree with that. I think you need much more clarity in terms of fiscal and, administrative type policies, and we don't even know who's going to hold that office, come the end of November, end of December. So I think that that's critical. Could they float some ideas? Could they come with some rhetoric, like a verbal attack on the markets here, with the intent to stimulate to whatever degree they can without doing anything? You could see that in August, centered around the Jackson Hole Symposium, yes. But in terms of real hardcore action, and then let alone if they do something, they need to do something that's significant, because every time you go through one of these cycles, you have to keep pumping more money in nominally to get the same percentage impact on money supply. So there's a lot of question marks here.
Greg, let's talk about the strength of the U.S. dollar. You're bullish on it. Is it really the best option out there right now?
Unfortunately, yes. I hesitate to say that it's the best option because I don't see any great options. But yes, simply because it's appreciating. It's appreciating against a lot of currencies, and I think very important to watch what's going on in China. By the way, the swap rates are down; they're below where the official rates are. There's a lot of pressure for them to cut. Inflation is falling faster than cutting interest rates. This has actually put their currency under some pressure, and you get a breakout in dollar against the renminbi. I think that's significant. You look at their numbers that came out today, their imports down big across the board. I think this is problematic in terms of their currency, in terms of their economy, and in terms of their approach, and the fact that they are behind the curve in terms of addressing it with monetary policy. I think all of that bodes well for the dollar, and if dollar renminbi breaks out, I think that's your next leg up in a dollar bullish trade here for sure.
You mentioned China, Greg. We're seeing slowing economic growth there. Obviously, base metals will be impacted. How about silver, which is an industrial metal?
Yeah, it doesn't look good here. Technically, I think the fundamentals are not supportive. So, to me, the path of least resistance is to the downside for now, and that goes across the board in all these industrial metals: tin, nickel, aluminum, zinc, copper. Copper looks iffy right here, as we speak, as does silver. So I think, platinum, palladium, same story. It's across the board. It's all asset prices. It's, global stock markets too. It's the same dynamic. You look at some of the places where markets have been weakest, it's commodity-linked countries like Brazil, for example. So, I see a lot of that. The evidence is pretty broad-based, and I think there's more downside before we see a bottom. Yeah, absolutely.
Greg, so I know you're bearish on gold right now. When do you think that market could start picking up again?
I don't know. I mean, it could happen overnight. So this is what makes it so much fun and yet so terrifying to be doing what we do with money at risk every night. It could happen any day. My sense is it's going to be a more prolonged period of time here where it doesn't happen. So I really do look at fourth quarter towards the first quarter of next year as some time where the Fed could come back into play, and I think that will be significant. I think between now and then, though, it's going to be difficult to, for them to get a green light, politically, and a green light, in terms of their mandate.
So, Greg, if you had to choose, what would dictate the price of gold most right now? Is it really the direction the Fed will be taking?
Well, it is, absolutely. It's reflation versus deflation. It's that simple, and we have come to the point where we're addicted to this liquidity. These are not the right things to do. I mean, it's not academically correct to do any of this. We're past that point. What it is pain avoidance, and debt deflation more painful than reflation. Central banks feel they can deal with reflation when they need to, that rather than having to deal with the debt deflation. They don't want to do that. They're staring into that abyss. They will choose to reflate. I think that is the bottom line human response. So to me, it becomes a function of, can they reflate enough? Can they print enough money? And this is right now, they don't have the will or the mandate from the public or from the political side of this to push. The mandate from the macroeconomic side is most definitely there. These labor numbers, horrific. I mean, really, really poor. So it sets up a very interesting thing. But for them to act now ahead of an election would be seen probably as political. So they can't. It's problematic. But that would be the single thing I would focus on, yes.
Is price deflation one of the greatest enemies of the metals, Greg?
Absolutely. Absolutely. And you're seeing that right now. You're seeing price deflation. It's across the board. It's in most all commodities outside of some of the grains and oil seeds. And it's pervasive when it happens without a central bank, without most any central bank, pushing where rates are negative and becoming more negative. Now, the problem, of course, is that, that gravy train runs out at some point in time. Have we reached that point where we are saturated to, even if they pump more money, it's not going to matter? I don't believe that. So I think there's a whole nother down cycle and then a whole nother big up cycle coming.
So, Greg, you did say we could see a breakout for gold, but in the meantime, what trading range are you looking at for the metal?
Well, I think you have a chance, and this is going out on a limb a little bit, but I think you have a chance to get gold down to the 1,300 level. I think if you can crack this 15 and a quarter level, and if you look at gold, say in Aussie dollars, for example, so even a more kind of negative picture, I think you do have some significant downside. I mean, it's nobody's printing, the economies are not healed, and they're deflating again. I think, and the dollar's rallying. I see it's going to be very hard, to have upside pressure in gold when you do have a lot of people that have bought into gold on the idea that it's a safety valve, that you can put your money in gold and it's always going to be safe. And they're going to learn here that, it doesn't mean it doesn't have its ups and downs. It's periods of appreciation and depreciation, and it could fall $200 and, force some of the weaker hands out. I think you need that kind of flush here. Then you'll bring central banks into play. It works on a timeline basis, and you're looking at 2013 as being more positive.
Greg, good stuff. Good stuff. I'll leave you the last word. Final thoughts for investors watching.
The only thing I would throw out there is that we have a managed accounts programs. We operate as a CTA here in the U.S., and we have, pretty high minimums. We've had a lot of, interest in our macro discretionary programs, and we're now bringing a smaller minimum investment program. It's a $150,000 investment that is a metals-only trading program that seeks to take advantage of this volatility, both up and down, in 7 industrial and precious metals. The track record is, it's hypothetical. It's been back tested, but it's pretty impressive. And we welcome any of your listeners or watchers here, viewers, to, contact us to get the statistical information on that and the track record.
Thank you so much, Gregory. And I invite all our viewers to check out your website, weldononline.com. Some great material on that site. Thank you so much. I hope to see you soon.
Yeah, my pleasure. Thank you very much.
And thanks for watching this edition of On the Spot. I hope you enjoyed it. You can email me, as always, at newsfeedback@kitco.com. For Kitco News, I'm Daniela Cambone.